The markets continued to consolidate today, but note that the Dow used the 50 and the T-line as a support level and closed near the high end of the range. This is basically telling us that there isn't any real powerful selling pressure on the markets, just some consolidation. The evidence of that was seeing the trading support right on these moving averages. That was also evident in the NASDAQ. Note how over the last couple of days after the evening stars signal, they pulled back right to the moving averages, the 50, the 34, and then closed back up above the T-line today. Once again, this is illustration that these levels are acting as support, that our downtrend isn't starting, it's just consolidation. A common price movement is when they come up through a resistance level, they'll come back and see if it's going to act as support. If you see positive trading from here after they've supported on the 50, the 200-day moving average becomes your next likely target. Knowing that the markets aren't selling off with any great vigor allows a candlestick investor to take advantage of price patterns that we know have expected results. You can see in our recommendation on VIPs, you have a fry pan bottom. Notice where the fry pan bottom broke out with a J-hook pattern, and we know that wave 1 and wave 3 were going to be approximately the same, pretty much telling us that this level was not acting as resistance anymore. But now that we've broken out, notice what it did today. This is a trend kicker signal. Yesterday, it opened here, closed here. Today, it gapped up and went in this direction. We know the results of a trend kicker signal, usually more upside. We know the results of a fry pan bottom breakout, usually strong upside. This basically allows a candlestick investor to put 2 and 2 together and come up with very conclusive expectations. A bobble breakout, as we can see in IQ, came up, failed at the 50, pulled back to the T-line, now coming back up through the 50, tells us if this starts trading positive, wave 1 and wave 3 are going to be approximately the same. Once again, this allows us to put our funds in high probability trade situations. And the same occurs on the bearish side. If we wake up tomorrow and see the pre-market futures are showing that the market indexes are going to open much lower, HRL, Hormel Foods, notice what it did. It did a bearish engulfing signal close to the overbought area right here at the 50. This is called a blue ice failure, with the description being that somebody's fallen through the ice, they've come up trying to find the hole that they fell through, they can't find it, they drowned. Where's the next target? The next major moving average. So this allows you to enter at the appropriate time, that if they open this lower tomorrow, not only do we have a bearish engulfing failure at this level, but now we've got a blue ice failure that might be indicated by a bearish doji sandwich, meaning if it opens lower, the magnitude of this selling will probably be the same as the magnitude of this selling. Knowing these things, once again, allows a candlestick investor to take advantage of price movements. And knowing that we did a doji today in the Dow allows us to make a very simple assessment. Prices usually move in the direction of how they open after a doji. If they open this positive, there's a good prospect that markets are going to move positive. If they open it lower, it's a good prospect that we're drifting sideways. These are market conditions where you want to have both long and short positions in the portfolio. That'll be it. We'll see you in the chat room.